All right, good afternoon, everybody. Or if you're watching this on a replay, wherever you are, this is 12-Minute Trading. My name is Doc Severson, and with me over here, I've got Dave Lukas of 12-Minute Trading. And today is Thursday, the 26th of January, and we have ourselves a little bit of a rally on our hands as we go into tomorrow's PCE. In fact, it's been a relatively volatile but positive week. And so we are here to kind of deconstruct what's going on and talk to you and take your questions on our live program. So this is our live market update. Dave, what are you seeing out there, man?
Oh man, I'll tell you what. I'm watching right now through the end of today. I'm watching the NDX go through the 200-day moving average for the first time since what we say April. So last year. Bulls are in control right now, right? And I think yesterday was the telltale sign when we had almost a 70-point drop in like the SPX and what was it, a 200 and some point drop in the NDX, and that buy button got hit, took it all the way back up to even for the end of the day. That pretty much cemented that short term, at least, we are in a bull market. But I'll tell you, the big thing that for me that I'm watching, and it's time to be a little bit cautious because we are up at these levels. We've got daily energies that are exhausted. We've got a weekly energy that is the highest it's been, at least on my chart, in 3 years. So we have a major, major trend on tap that's going to start unfolding, maybe coinciding with the Fed next week. So, Doc, I don't know if you want to bring up the charts and show that, but I think that's where we need to focus our time today.
I would be happy to do that. Let's take a look here. So I've got a triple pane chart on the S&P 500, and let's just kind of open it up. And so here's what Dave's talking about. We have the monthly, weekly, and the daily. And when Dave's talking about the energy, this is what he's talking about here, is that if you look at this study here, it's almost like a fuel gauge with full at the top and empty at the bottom. So this means that there's been absolutely no trend over the past several weeks, going all the way back into like November or so. And there's no net price movement since then. And this is like winding a spring up tighter and tighter and tighter. The more potential energy that you put into a spring, the more it's going to turn into kinetic energy as it flies out of there. And so we're not only seeing that at the weekly time frame, but also the monthly time frame as well too. Look at this. We're going back several months on the monthly time frame, and there's just no net price movement. And then we're actually even looking at this on the daily chart to a smaller degree. And if you want to play price patterns as well too, a lot of people out there in the internet.
Doc, that's the monthly chart. That's the bigger one. So we are, if you look at the monthly and the weekly, both fully charged.
Yeah. So here's something else on the price pattern perspective. And this is what I did a market minute on this a few days ago, but we're getting, if you look at this now, admittedly, these are subjective, these are open to interpretation, but if you look at that, that is an inverted head and shoulders pattern, which is leading up to a potential upside target, measured move target about 4,300 or so. But that in conjunction with the main one, this is also another inverted head and shoulders. So we have fractals, we have patterns within patterns right now. And this has got a potential going from 3,500 up to 4,200. That's a 700-point potential breakout. So that's pointing us to potentially a measured move of 4,700, which is very close to the all-time highs on the S&P. So it's, like we're not discounting the fact that we could see the Fed say something next week and we just completely puke to the downside. But here's the important thing, and I'll shut up on this, is that what we're looking at is the polarity here. We have lower highs since the beginning of 2022. We've had lower highs, lower lows all the way along. And then what we did was we had another lower high. And then here was the important thing. And this is what I'm always looking for, is I'm looking for a potential change in polarity. And in December, we printed a higher low. Now, this is the first time we printed a higher low on the weekly chart. And we're inches away and maybe a day away from printing a higher high. And that would be a full change in polarity in the weekly chart. That is not trivial. That is not something that we can sweep under the rug and say, oh, you're just being bullish or whatever, right? You're just viewing the market through rose colored glasses. This is what we do. We use price action to understand what's happening here because price will never lie to you. And this is what we say price pays. So this is an important signal, and it's kind of fun to see something like this actually happening for the first time in a year. So have we had the capitulation yet? I don't know. It's hard to. Every bear market is different, though.
I don't. This no bear market has to be the same, and they never are. And you don't have to have a capitulation event where the market sells off, 20% in the span of a week to capitulate. I mean, NASDAQ was down 35%. Most would say that was a pretty deep move in the NASDAQ. And guess what's kind of leading this rally right now? That's affecting the SPX because the tech components on the SPX, right? So the old adage of you got to have this massive capitulation before everything ends, you're in a different world than things used to be. We talked about this in our year in review event that we had for people just a few weeks ago. We don't live in a truly free market anymore the way that we haven't been in a free market for a very long time. But ever since 2008, with the massive manipulation essentially from the central banks and everything in the markets, it's almost impossible to say things are going to work like that anymore, just because there's so many things that are now underpinning and propping up or either holding down the real animal spirits of the markets, right? So that's the big thing, is that we've got this completely different world that we're in. So just because something happened a way like it did in 2008 doesn't mean it needs to happen now.
Yeah.
We could turn around from here and go to a brand new high, and that's the way it is. That's why price is all that matters.
Yeah, we have to remember why things were so bad in 2008, because credit markets had really locked up. I mean, there was no velocity of money. No money was moving anywhere at all.
Right.
Across the market. That is not the problem. We have banks that are capitalized right now. We've just gone through a huge corrective period, which has been led by the former leaders. And so now we have the former leaders coming to prominence once again this week, which is kind of exciting to see that all over again.
If you remember, we were talking in December, and I said there's a few outcomes, right? We could get some massive run up to start the year, and then the rug pull happens, right? And we get that, and coincides with the most telegraphed recession in history and all that stuff that we've been hearing about, right? But GDP came in today at what, 2.6?
2.9.
2.9. So maybe the estimate was 2.6. So there may not be a recession, right? In that, maybe the recession already happened where we had actually 2 negative quarters in a row, right?
Well, it did. It did. And we, where everybody's trying to, gaslight each other in terms of what terms,
But yeah, I mean, so we're at a point where maybe this thing already has happened. We're coming out of it, and we're going to go into a big bull. And with the weekly chart, as we just showed on that screen a few minutes ago, that's not going to stay there indefinitely. That's going to start to move over the next few weeks. So this is a time where it really, really pays to be patient.
What do you make, Dave? What do you make of the Fed funds futures that we're pricing in 2 quarter point rate hikes into March, really? So the next 2 meetings, we're going to go up another 50 basis points. But then if you go look at the end of the year, the interest rates are right back to where they are today. So what that is saying is that the Fed's going to have to cut 50 basis points by the end of the year. So why would something like that happen? Are we pricing in like we're going to have some kind of, episode or damage going forward? Or is that, I can't imagine why the Fed would cut other than to rescue the market.
Yeah, I mean, who knows? It could be. I mean, remember, the bond market is separate, right? The bond market is separate from the Fed funds rate. if you will, right? Fed funds rate affects your credit card. It affects your home equity lines. It affects things like car rates and stuff when you're buying or leasing a car. But it doesn't affect the 10-year bond is a separate market, right? The 135, the 6-month T, all that's a separate market. So I think what they're looking at is the Fed is at the end of the cycle. Inflation's coming down. So you've got short term, yeah, rates are up. So they're up paying effectively what CDs are paying. That's you can get a 1-year CD for 3.7 to 4% right now. So that's where the rates are because it's competitive, right? That's why those rates are there. But longer term, those CDs and stuff are going to come down. It's a supply and demand thing, right? If a bunch of people are getting into those or moving into those, then you're going to have that change in the interest rates and stuff. In fact, CD rates have already started coming down some, right? Because they were over 4 just a few months back. And a lot of that reflects the fact that the Fed is done effectively. I think a quarter point is symbolic, but really what does that do at this point? Not much. Another quarter doesn't do that much, right? And you have inflation that's still going to be higher than where they'll be if they do that as of now, as of today. So the Fed may blink. The Fed may not raise at all. And maybe that's what the market sees actually happening is that they won't raise 2 more times, maybe just 1 more, and that's it.
I've got to look back at this, but I do recall hearing sometime over the last decade that as January goes, so goes the rest of the year.
Mm-hmm.
Now that's one of those, altruisms. It's like, is that just,
sell in May and go away, right?
Right. Is that just like one of these old pieces of folk knowledge that's been passed along through the years? But, you have to look at this and say, after the year that we've been through, to have a positive January and a higher low on the weekly chart, this is all pretty good, so I'm optimistic
right now,
that we can.
This is set up to just grind and trend higher. We are set to we have all the makings to change polarity.
And if you go back and listen to our talks over the last few weeks, both of us have said on this program, we both said, hey, everybody's negative. That doesn't make sense. Maybe we should take the opposite way. And that's paid off so well.
It'll do the opposite of that.
Yeah.
And that higher low is really, really key. It's on the daily chart. It's on the weekly chart. And the other thing is you've been at the bottom Bollinger Band on the monthly chart. I give a lot of credit to the Bollinger Bands because they really do act like the ropes of a boxing ring and keep the price inside of it. And so we came down, we hit that lower Bollinger Band and we bounced off of it. And that's a pretty normal thing to do. Now we've got a monthly chart that's fully charged. We're near the lower Bollinger Band. Typically, you're going to go the other way unless there is a massive catalyst that's not priced in to tail that energy to break down from there, right? And I don't see it, right? Do you? I don't see, maybe, nuclear war breaks out. Then it goes the other way. But as of now, there isn't any major catalyst that is just Armageddon priced in to take this thing the other way as of now.
Dave, one of the things that I've learned over the years that, we're all human and we're all influenced by things that, our reticular activating system will go out and feed us information that we find receptive to. This is why people watch certain television programs and watch certain networks and things like that. We all do that. But one of the things that I've learned is like, if I could just tune out all the news, if I could just, trade exclusively on price, man, wouldn't this be so easy? And I think this is one of the biggest opportunities I've seen in years, that if you can just tune out all the noise, all the bullshit, all of the, just the social media, everything like that, and just look at the price. And that's why I'm so excited right now, because this is one of the most pure plays that I'm seeing. I'm saying this is a huge tipping point. We could die here. This could set up as a lower high and roll over and absolutely puke. But based on the way that things are moving, rule number 2, reversals start from the inside out. Yeah. And, this all looks really, really good. So I am optimistic right now. So
Holding 4,000 the way the SPX did yesterday was a very telltale sign for me. To
yeah.
drop 70 points below there, go down to like 39.40s, and then come all the way back and hold it tells me there is incredible strength
Yeah.
to the upside right now behind this.
There's probably
Again,
a lot of sideline money, people that got shaken out all of a sudden sitting on the side waiting to come back in.
A lot of retailers are getting back in. I read a thing about 2.5 billion of retail trading came back into the market. So here's what you guys got to look for before we wrap up today, right? If we do start this trend in this weekly and this monthly chart release, okay, and this starts to go, here's the thing you guys got to remember. If it's driven by these retail traders, all these people that want to get in because the market's going up now, and this thing goes parabolic, it is not going to end well, right? It's going to be a hell of a run up to the upside, and you may tag a new high, but if it goes straight up like parabolic, it will crash just as hard. It needs to grind higher. If it does not grind higher and get there slowly over time, it is almost impossible to sustain. So you need to watch the temper of this market, because if we really go on the run and it's parabolic to where you go up 10, 20% in the span of just a month or two, right? We're already starting that this month. It usually doesn't end well.
Yeah, that's good advice. You know, it's something where what you want to look for is what they call the most hated bull market in history. We want to have one of those. When we get into a market that climbs the wall of worry, where people say, wait a minute, this doesn't make any sense. This is, you know, look at this data point over here, and we have people in the streets, and this is going on. When you have a market that makes no sense whatsoever, that's usually the one that you want to be on board with. You know, it's the one where everybody agrees and everybody is bullish. That's where the euphoria area is. That's the time to be careful. But I agree. Like, you know, if this thing rips a little too hard, and it usually happens at the very end. We usually come strong off the bottom, and then we get into a really fat period in the middle, and then we go ripping to the upside as everybody, because there's going to be so many people that don't want to, they're going to be sitting on the sidelines through this thing for a long time before they're going to be comfortable getting back into this. So 2022
last point to that, because I know you're a big follower of this too. 4 phases of the market: disgust, disbelief, acceptance, euphoria. I think everybody would agree that we've been in disgust for quite some time. And this could be disbelief.
This could be disbelief.
Rallies and disbelief. Nobody believes this thing's going to hold. There's no way that the mother of all trend lines isn't going to work this time, and so on. And then we blow right through it, and people are still like, I don't believe it. I don't believe it. Until they can't take it anymore, then it's accepted. Then you continue that rally, and you get into that euphoria where you just go parabolic in the end, and that's when it all comes crashing down. Now, if this is a monthly swing, that can take over a year, right? So I'm not saying there isn't going to be a tremendous opportunity. Just be careful with it and really let it prove itself and where it's going for the next few weeks, right? Remember, don't try and time it. Don't try and time a bull or anything like that. Just get it confirmed and take advantage. You have plenty of time to take advantage of it. This is very early stage at this point, if that's where we're going.
Very, very early. Well, wise counsel.
Yeah.
All right, folks. Well, we look forward to talking with you guys next week. Are we going to be on next Monday? Yeah, we will be on Monday. Back to the normal schedule. Yeah, back to normal schedule. So it's just going to be a couple of days. So we're gonna get a chance to catch up before the Fed comes along and potentially ruins our. Goes. Yeah, we'll see what happens. So, all right, everybody. Thanks for watching us. Whether you're watching us live, for those of you out there live, hello, or if you're watching this on a replay, which is probably most of you. Again, we are Doc and Dave of 12-Minute Trading. So we do this once a week, and we'd love to answer your questions. So go ahead and fire those in, support@12minutetrading.com, and we'll address your question on the next session that we do, which is apparently Monday afternoon. So we'll look forward to talking with you then. Thanks, Dave. And from 12-Minute Trading, that's it for this week. We'll see you guys soon. Have a good weekend.